So great. Wonderful article that came out in the Times of India today, which I want to read the headline just to make sure that everyone's on the same page. And then I have a question for you. The headline is, and this is the front page of the Times of India, it says Sensexy at 60. It's basically saying the Sensex is at 60,000. And then I'll go read the subheading as well. It says BSE's benchmark index has been hitting newer and newer highs amid the pandemic. 8 months after touching 50,000, it's raced another 10,000 in record time. It's a very sensational headline. My question to you is, what do you think of it? I mean, why is it even there? Why does it need to be on the headline of Times of India?
I saw that headline, and the other subheader there is also very interesting about the thousands of lakhs or God knows what kind of money people have made by being in this market, right? But here's the interesting thing. These kind of headlines happen again and again. So in January, when the Sensex hit 50,000, you and I had written a blog piece about it, saying 50K, how's the Josh? Because that again marked a point saying, my God, COVID, pandemic, the world is coming to an end. And the stock market kept going up. And, you know, and as every time this kind of headline comes out, it generates two types of emotions, right? So you've got your excitement, the sensational, right? And people feel, am I missing out? Should I have invested more? Look at all these people who made money. Should I jump in with some more money now? So that's the usual first emotion that some people feel. The other people feel the other emotion, which is fear, saying, my God, I'm invested in this market. It's hit this, you know. The other part of this story is about how quickly the market has moved from 50,000 to 60,000 in just a few months. I think, should I get out? Should I, quote unquote, book profits, right? The very technical language that people like to use once in a while when they want to chat about these very sophisticated ideas. So you have all these emotions out there, and then the question becomes, how do you decide? How do you decide, you know, what should you do? Should you stay invested or should you get out? Because remember, if you were somebody who was waiting on the sidelines when the Sensex hit 50,000, saying, you know, the market is very high, I think it's a bubble, I think it will crash, I don't think I should invest at this level. Well, 50,000 is now 60,000. How are you feeling now? Are you still waiting?
In fact, before you touch upon what I think you will as the possible way to look at this and deal with this, I just want to share some anecdotal evidence or conversations that we've had with our clients over the last couple of weeks. And we've actually had these two kind of conversations that you just referred to. We've had one client who has said that, listen, the markets are really going up, and I think I should deploy more money into equity.
Yeah.
So that is that entire greed thing. And we've had conversations with people who are now getting very, very nervous. And they're the same people who were getting nervous even at 50,000 Sensex, who are now talking about the imminent crash, which is around the corner. And I must confess that, you know, when I wear my investor hat and not the other hat, I oscillate between these two emotions almost on a daily basis. There's a part of me which says that, listen, let me put some more money behind equity. And there's a part of me that says that, listen, it's time to kind of book profits. The question that I want to pose to you is, how does one break through the noise and do something for their own portfolio? Is there a science to it? What do we profess to our clients?
I think the important thing to remember is what not to do, right? One of the things that you and I talk a lot about is that successful investing is not as much about getting things right. It is actually more about not getting things wrong, because a lot of people end up making a lot of mistakes, and that's what really, you know, hits them in their portfolios. So I want to talk a bit about what you should not do. And what you should not do is try and predict what the markets are going to do, right? So all this talk about a crash is imminent and around the corner, We don't know. At 50,000, you could have said that. Sensex at 50,000, you could have said crashes around the corner. Well, we are now 20% up from that level, right? 10,000 on 50,000 is a 20% increase. So you've had a stock market that's given you a 20% gain from January to September, 9 months, right? Which is an amazing rate of return in an economy that is not fully open yet. So to try and predict what the market is going to do is what I've called a fool's errand. I wrote about this. I'm saying it's a fool's errand. It's a pointless task. You will not be able to succeed consistently trying to predict what the market is going to do. So that's something you should certainly not be doing. The way to go about it, and that's what we do for our clients, is to focus inwards and not outwards. To focus on our portfolio, to decide in our portfolio what percent of that portfolio should be allocated towards equity, and try and make sure that the portfolio stays about there. So in a rapidly rising market like we have right now, that percentage number will balloon. It'll become very large. And that's when you do your book your profit idea, right? That's when that kicks in. Equally, if there were to be a big fall in the market in the next few months, at some point in your investing life, you will see a big fall in the market. It's unavoidable. And at that time, your percentage allocation to equity goes down. And that's when you get into your debt side of your portfolio, take money out from there, put it in equity and bring it back to that ideal asset allocation for you. Now, ideal asset allocation is a whole different conversation, and how you figure that out, that's a longer conversation. But the minute you have this kind of rule-based way of dealing with market uncertainty, saying, listen, I'm not going to worry about what the market is doing. I'm going to look at what my portfolio is doing. Is it where it needs to be? And that's what's important. I want to touch upon one other thing, which is very interesting about this whole 60,000 number, right? The market closed above 60,000 on Friday, and that is an all-time high for the Sensex. But on Thursday, the market closed above 59,889, which was also an all-time high for the market. But on Friday morning, you did not see any of these kind of sensational headlines. Right? And why is that? Because we like round numbers. It's irrational, right? Why should 59,999 be not as exciting as 60,000? It's not. It doesn't have the same punch. The headline doesn't really come across, as punchy.
Because then you can't really say Sensexy at 60, right?
Correct.
Absolutely. It's a little blander than that.
So that, in fact, if you think of it like this, you realize that all of this is just noise. This has no bearing on your portfolio. You should have been equally excited about this on Friday as you were on Saturday. Or trying to make the same decisions, driven to those kind of decisions, saying, should I get in, should I get out? All of those things should have been happening to you on Friday. It did not. On Saturday, it did, because you're being driven by noise that you're hearing in the market, which has no bearing on your portfolio.
So what you're suggesting is that as an investor, I should not be bothered by what the markets are doing. Another thing that kind of came across was that in your investing career of 10, 15, 20 years, which is what most people's horizons are that long, the ups and downs are going to come, right? So you forget looking at that and you just stick to your asset allocation and make sure that you take timely action as a reactive person. So if the markets fall, then you move money from debt into equity, and if the markets rise much higher than your asset allocation permits, then you move money from equity into debt. The trick then comes down to figuring out what your ideal asset allocation should be, and that, I think, like you said, is a long conversation. But here's one last thing on this subject. You can't help but get engaged in conversations where people are trying to predict the markets.
Yeah.
I mean, this article in itself has 2 sections, right? So it has one section called the risk factors.
Yeah.
So it tells you all the reasons why the market will fall.
Yeah.
And then it has another section which is called what is driving the rally. And they talk about all the factors which give you hope to believe that the market is going to go up even further. And you just can't help it. A lot of your clients come back to you and say, "Kya ho raha hai? What's going to happen? Will the market go up? Will the market go down?" Is there something that you'd like to say to kind of address this? I get the point that that you should look at your asset allocation, but then there's that inherent sense of excitement that people have in trying to predict outcomes, right?
So number one is to accept and admit that this is all very natural, right? Ultimately, we are creatures of emotion. Much as we would like to be rational about these things, we tend to be emotional about these things. Nothing wrong in it, as long as you are aware of the fact that you are being emotional about it, right? So the market could have ticked up to 60,000 over a 5-year period very, very slowly. And nobody would be very excited about it. But because it does it, maybe they wouldn't have been this excited. But if it does it in a shorter frame of time, everybody gets far more excited about it. I'm reminded of a story that Warren Buffett once told at his annual investor conference. He says, you look at the difference, I'm paraphrasing obviously, he says, you look at the difference between the way people behave with regard to the price of their house versus the price of their stock portfolio. He says the problem with the stock portfolio, if the housing market behaved in exactly the same manner, it would be like you're living next to a crazy man who every day comes to the fence and yells out numbers to you saying, this is the price of your house today. And sometimes that number goes up a lot and sometimes those numbers go down a lot. And he says, would you get very worried about the value of your house based upon that? You wouldn't, right? You'd say he's crazy. He keeps shouting out these numbers. They have no basis in reality. The stock market tends to be a bit like that. It tends to be emotional. It tends to shout all sorts of things. And, if your portfolio is right, if your asset allocation is right for you, if your portfolio is right for you, you're invested in the right kind of stocks, mutual funds, whatever, you can ignore this crazy man who's coming to the fence every day and shouting numbers, right? You don't have to pay attention to Sensex at 60. It's,
Fantastic. Well, that's a wonderful anecdote to end this conversation with, and we'll hopefully come back to everyone next week with another topic that piques our interest.
Sensex at 70,000.
At 70,000. You never know. You never know. Maybe at 50.